Hey, everybody. Welcome to the Wealthpress Weekly Market Wrap-Up. I'm here with my good friend, Roger Scott. Roger, how are you today?
I'm doing great. And how are you doing, James?
I'm well, thank you. It's a good Friday all around with markets having the best single week they've had since, I think it's the Great Depression.
Yeah, we've had the worst news since 1948, and at the same time, we've had the best market action since the Great Depression. It's a crazy time. We're in a crazy time, James.
It is. How do we reconcile that contradiction?
Well, great question, and this goes to what you and I have been, talking about recently. There's two ways of looking at this. There's two completely different ways of looking at it. One way is what's going on? What are people reacting to? Why is the market bullish? And the answer is really simple. No one is reacting to the news. Look, we've had yesterday, we've had the worst 6,600 new claims for the week, and the stock market rallied. No one's looking at jobless claims. No one's looking at unemployment. Nobody's looking at this CARES Act. The only thing the market's completely headline driven right now, and the market's looking at that curve flattening. It's looking at that corona curve flattening, and it's seeing no increase of deaths. It's increasing. It's showing better than reported fatality rate. In other words, they were expecting 100 to 240,000. The market's now looking at between 40 and 60,000. And I think that number is going to back out based on the number of people that are inflicted at this point, or infected at this point.
Mm-hmm.
Yeah.
Right. Okay. So then given the exuberance in the market and the sentiment of risk on that is apparently defining the market sentiment broadly at this point, is it safe to say that investors have more or less embraced the idea that the Fed's rescue efforts are, in fact, in the short term, sufficient to justify increased investment in the traditional market foundation like the S&P stocks and the S&P ETFs?
I'm gonna be very cautious, but I'm going to say yes. And look, all the negative headlines we had this week, if we had these headlines a year ago, the market would be limit down within 5 minutes. 6,000 new claims, market rallies on it. The truth of the matter is, and when you say short term, I don't know if it's short term, but look, the Fed is putting the most money they've ever put into the market. And I was talking to a very, very knowledgeable hedge fund manager, and we both agreed that this is just like going back to the future, going back to 2008, and doing exactly what the Fed did, and it artificially erases a bear market. Now, are we going to be paying the price for this down the road? Is the increased debt getting higher? Yes, but no one wants to talk about it now. And the way I'm looking at it is kind of like how everybody's world is concerned about this world becoming stabilized in terms of its health. But nobody was looking at it that way from 20, 30, 40, 50 years ago. Uh, green energy, green fuel, keeping the world clean was not a major concern, but it is now. So I think something is going to happen in the next 15, 20 years where people are going to say, okay, wait a minute. Someone's going to be smart enough to say, hey, look, we can't completely just focus on the stock market. We got to focus on the underlying foundation. We got to see what's causing the stock market to rally. What's causing the stock market to rise? Is this really money, or are we just rallying on debt and debt and debt and debt and debt? And I think that's what's going to happen till somebody just shakes us up and says, guys, what are you thinking? What about Social Security in 30 years? I mean, something has to happen. But until then, everybody's just turning a blind eye, James.
Sure. So, as part of the perception engineering exercise that the Fed is obviously fully cognizant of and arguably underpins their logic when designing these rescue packages, do you think that they are right in their position as moderators of global sentiment to be specifically targeting how an individual opens up their 401k account and says, oh, my stocks are up, therefore I'm happy and I'm relaxed and I'm not panicking, and ultimately, the better my 401k does, the less concerned I am about Social Security, unfunded Social Security obligations in the future. If my portfolio keeps increasing at the rate of 20% per year, then I really don't care about Social Security. And arguably, that is within the mandate of what the Fed has set out to do, even though one could argue that the tactics in use are compounding the pressure on future generations in terms of global sovereign debt.
I couldn't agree with you more. First of all, the Fed shouldn't be doing what they're doing. They're a little too focused on the stock market, and they're a little too focused on the market timing, and they're a little too preoccupied with what our president thinks. There should be a complete separation between the Fed and the executive branch of the government. I'm not seeing that, number one. And look, I love this country. I'm American inside out. I love this country. There's nothing I love more than this country, but this is going to come and bite us in the ass. This is going to come and bite us in the ass because the Fed is not looking at this the right way. They're doing everything for the short term, but they're completely ignoring the long term. And that's not the way. That's not because look, ultimately it's going to bite me in the ass. It's going to bite my kids in the ass. This is bad. Debt is increasing. And I'm going to tell you another thing. How irresponsible is it to allocate an X amount of money before you know what the damage is? Why was the necessity? Okay, first of all, this CARES Act, we don't know what percentage is a grant. We don't know what percentage is a loan. It hasn't been figured out yet. Certain industries are not going to get money at all. For example, the hospitality industries are going to get stuck with barely anything. We don't know the full impact of the damage. It's kind of like somebody asking us to come to clean a house without telling us how big the house is or what we need to do. We don't know the extent of the damage. So I think it's very irresponsible for the Fed to behave the way they are doing. And I think they've been irresponsible for the last year. They've given too much clarity in terms of what they're going to do. They're not supposed to be doing that. They're supposed to keep us in suspense because they're supposed to not dictate what the stock market does. They're supposed to be surprising the stock market. They're not doing any of that. So the Feds that we saw 40, 50 years ago, it's a different Fed. It's a different Fed. And I think what they're doing, here's how I would have done it if I had a choice. And I know we don't have all day here, but here's what I would have. I would have said, folks, we're here to help you. We're going to keep this economy stable, but let's see where we stand. Let's see how bad this condition gets. We're going to help the homeowners. We're going to help the mortgage industry. I mean, think about the level of irresponsibility. They passed the CARE Act, but they forgot to give mortgage lenders a liquidity bank. So they're telling people they don't have to pay rent right now, but mortgage lenders or mortgages, but mortgage lenders have to forbear these costs. But at the same time, there's nowhere for them to pay money from. So mortgage industries writing letters to the Fed over the weekend, literally overnight, saying, help us, help us, help us, help us. And there's no help coming. So the Fed is making promises that they're not literally keeping right now. They will keep them in the long-term frame, but to allocate X amount of money, to not clearly spell it out, to just jump into this and say, we're going to help, unlimited support, no matter what. How can you do that? Are you just going to print money? So I'm having a lot of trouble with not what they're doing. I'm having a lot of trouble with how they're doing it.
Sure. Okay, I think that great disconnect where the Fed has basically, through the CARES Act and through the emergency legislation, has said, okay, you don't have to pay your mortgage, and mortgage companies, you don't have to collect those mortgages. Yet, no matter what, the mortgage companies that have sold their debt in tranches through securitized debt instruments to mortgage investment funds have no choice but to report a non-performing asset in the case of any mortgage that is not paid. And arguably, the accumulating effect of that is happening as we speak,
literally,
as people fail to pay their mortgages, is that these entire tranches of highly rated debt in securitized instruments are non-performing, which invokes certain covenants in their clauses that basically is exactly the condition that preceded the onset of the collapse of Lehman Brothers and Bear Stearns in 2008. So
Exactly.
it's like
Exactly.
the Fed, while trying to help, is actually, it's like, you move your car in the driveway and you accidentally back over your wife's favorite dog. It's like, well, thanks for moving the car, but you've just made your life a lot worse.
Right.
And it's
Right.
like, is that disconnect something that they are, I mean, they've got to have this oh shucks moment where they go, oops, like, oh yeah, we've got this giant chasm that we forgot to put the bridge over, and all of these mortgage funds are one by one falling into the chasm. It's just a matter of time till the effect of that is much greater than the beneficial effect of our rescue
Right.
efforts. So
Right.
they're going to have to do something, and we know that. But that doesn't affect us as investors per se directly, except that the headline news drives negative sentiment when large groups of funds start collapsing. But for our audience, for your and my audience, our investors, what can we do to take advantage of this situation and position ourselves for upside?
Well, that's a great question. That's a great question. The key right now is because ultimately in the short term, and the short term may be 5 years here or 8 years, I think stocks are going to go higher. NASDAQ 100 already broke above the 200-day moving average. On the upside, if we do one more day above the 200-day line, we're officially in a bull market again. So a lot of traders, and including yourself, is asking me, where's a good place to put your money right now? I like some small cap stocks right now that have been beaten down, but these stocks are in industries that are going to be rising as a result of what we're seeing right now. Okay. So, and they were also companies that were doing really well. Now, there's two of them, and I'll just briefly go through them with you if that's okay.
Sure.
The first one is Plug Power. Plug Power, ticker symbol PLUG. It manufactures hydrogen fuels that replace conventional batteries in vehicles. So, as you can imagine, traditional fuel sources, we're going away from that and we're going to cleaner energy and bio and electrics fueling cars. This company is in the forefront of this. It's a next generation stack technology which pushes hydrogen fuel costs lower, and they have a really good margin. They have a lot of cash. The stock is trading above the 200-day moving average, and a lot of analysts are beginning to get behind this company. I like this company a lot. The 5-year target for the stock is about 4 times higher than it's trading at right now.
Wow. I'm writing
Yeah.
that down, Roger. What was the symbol again?
PLUG.
Wow, that's a good symbol.
Yeah, plug. And
Okay.
if you look at it, again, it's designed to take advantage of something that's very new, an industry that's new, and the more oil, the more oil does what it's been doing, the more companies like this will come out and play, so to speak. So that's number one. It's also a leader in hydrogen systems. And again, these companies in the next 10 years, they estimate, I don't know how familiar you are with Tesla and so forth. I'm not there yet. I don't feel comfortable buying that yet, but it's inevitable. In the next 5-10 years, the writing is on the wall.
Yeah.
We're definitely whether we like it or not.
Well, we can see Tesla's on a nice recovery here in the
Yeah.
chart.
Yeah. Yeah,
And
I have mixed feelings about Tesla again, and it's just it's a personal bias I have. And then the other stock is Every Holdings. Now this is an interesting stock. It's born out of a merger, ticker symbol EVRI, and it's born out of the merger of two casinos, industry heavyweights. But it doesn't. It's a B2B company in the casino industry. It's a merger between global cash access and multimedia games. And what they provide financial technology solutions and intelligence. So they're not a casino, they're a company that provides technologies for casinos as casinos are becoming more virtual. And as you know, casinos are becoming more virtual, especially with sports betting and things of such nature. So this company has been doing amazingly well. It's not, don't confuse this with a brick and mortar casino. This is not what this is. Macquarie, that's a very big investment firm for this type of space, has issued an outperform. And the stock has a price target, end of year target at $15. It's currently priced around $4. All right. The P ratio is 10.90, where traditional P ratios for stock in this industry are about 13. The stock is outperforming the Russell 2000, and it's already trading above the 50-day moving average. More importantly, 6 analysts are giving it outperform ratings. And when the stock begins trading above $5, institutional money tends to come in. And it's right now between $4 and $5, right there. So I'm looking for this as we begin a recovery. I'm looking for these 2 stocks not to go up 50 or 60 or 80%. I'm looking for a 200 to 400% return.
Wow, that's incredible.
Yeah.
Okay. And have you seen anything in the COVID-19 sort of anti-vax vaccine or cure type of stuff? Anything interesting there?
I'm looking, but I'm not convinced yet. I want to give it one more week because there's a lot of talk right now, and a lot of this talk is wishful. So I want to make sure we have some. You're looking at articles right now. Yes, there's a cure. No, there's a cure. There's testing. There's no. It's very iffy washy, and there's literally. I have a call on Monday morning with somebody who's actually a doctor in Harvard, who is going to give me the latest information, and then I'll be able to share that with you. I'm actually going to have it early in the morning before our Monday morning round, our conversation. So I should have something Monday, but I don't have anything right now. I just don't want to say something that I may take back. I want to be very clear on this.
Yeah. Okay. Well, that's great. Well, next week I've got one for you too. And I'm going to go so far as to say that I think these guys have found a cure for the symptoms associated with the most severe cases. They've issued 70 doses under emergency IND FDA permission, and all 70 patients have been discharged within 48 hours of this treatment.
I have not heard yet.
Yeah, I'm not gonna reveal the name of the company because it's actually going into the April James West Letter as the top pick for the month, and I am conducting a high level of due diligence over the course of the weekend to confirm all of the representations. I conducted an interview with the CEO yesterday and some of the clinicians as well, and I'm just verifying that data. But I'll be able to talk about that next week, and subscribers to the James West Letter will get that information first.
I'm really looking forward to hearing this, James. You've piqued my interest substantially.
Well, so that's great, Roger. That's an awesome analysis as usual. Let's leave it there for now, and we'll come back and see everybody at the roundtable on Monday morning to get next week's opportunities, risks, and pitfalls, and how to avoid them from the Wealthpress crew. I'm James West.
Roger Scott. Thank you, James. You have a wonderful weekend.
Bye, guys. You too, Roger. Bye.